Greetings my YouTube family, thank you so much for visiting this channel, and on this channel we talk about personal finance and investing. So today I'm going to talk about fixed income investing. There are some people who may be at a point where they might just want some cash flows or for the short term and not necessarily to invest in the long term. So I've been exploring this kind of income stream, and I'm just going to share some of the potential opportunities that I found out. But before we get started, I just want to disclaimer that this content is just for educational purposes. As such, it should not be taken as investment advice. So most people, when it comes to fixed income investing, they think of guaranteed investment certificates or bonds. And when we talk about guaranteed investment certificates, mostly because of the rising interest rates, mostly in Canada and the United States, where I particularly follow the stock markets, the bond prices actually they actually follow an opposite effect. Like for example, if the interest rates are increased, then the bond prices, they actually fall. So what happens is that for most people, they might consider exploring some bonds, municipal bonds. They can be corporate bonds. In other words, some companies, some corporates, they might actually issue bonds, and then some people can get. But the interest, actually, from what I was looking, they've been decent. For example, quite a number of bonds that I saw on the market, they've been offering a yield of 4%, 5%. And when you look at inflation, which is the increase in price, the average increase in price over a given space of time, has been in Canada and the US has been increasing. So let's say someone wants to buy a house in a year's time. Some people might actually consider investing in guaranteed investment certificates, for example, for 1 year. So what that means, if it's annually you're going to get 5%, then what it means is you can get your principal plus that 5%, which at least kind of gives you a cushion from inflation over that space of time. Because the stock market, usually it fluctuates up and down. So if you have short-term goals like to buy a house, you might then realize that if you have invested your money in the stock market, and after at the end of the year when you want to then buy your house, then the stock market might be down 20%. So what that means, if you sell your securities or your stock, you can then lose money, right? So I particularly look at these investment options in the short term. If I am particularly looking to just avoid to have my money eroded by inflation, right? So I look at guaranteed investment certificates. So there are quite a number of banks, even municipality, even in Canada. I saw even the province of British Columbia, all over Canada, and even in the US, there are quite a number of bonds. But like I said, the bonds and interest rates, they have an inverse relationship. In other words, if the central banks, they increase the interest rates, their prices might fall, right? So what it means is that if you then redeem your bonds before maturity, you can then lose money. But if you wait until they get to maturity, then you will not lose your money in that case. So I think these are some of the options that I look at, and I thought I would just share, because sometimes people might not even realize that even if inflation is 4%, if you leave your money in a bank and not in a something that gives you some income or cushioning from that, then you are losing. It's more like a silent it's a silent tax, in other words, because if inflation is 6%, at the beginning of the year, and at the end of the year, that money, let's say if it was $100, it means in real terms you will be left with $94. In other words, in terms of what it can actually purchase if you compare or prorate it to the beginning of the year. So these are some of the things that I think, depending on the goals, if it's just for short term, I have no problem actually putting some of my money in the fixed income securities like GICs or even bonds, as long as I know that this is just for a specific period of time. What I don't usually do personally is to then lock my money for 3%, for 10, for 20, 15 years, when I know, or historically, in the stock market, there has been, quite a good return. But at some point, I think when I grow older, there's that relationship with bonds and stocks, that sometimes when stocks go up, the bonds, they go down. So if you are in retirement and the stocks, they drop, let's say for 3-4 consecutive years, it means if you continue to draw down, then the portfolio might actually decline significantly, in that sense that if you are selling at a loss, then the capital appreciation would be, in that case, actually potentially negative. So then the bonds, they come hand in that case. But I'm still young, so I put only a small fraction, but at least some money in the bonds, and then the stocks after, over and above the emergency fund. So that's it for today. I thought I would just share this, and I thought that it's something that might be helpful to subscribers. So please don't forget to subscribe on this channel, so that you can check out some content in the future. Thank you.